Hi, my name is John Stevenson, the Guarantee Retirement Guy. Today, I want to show you the top fixed index annuity rates in the market right now. Okay, so I'm looking at my computer screen and I wanted to pull up first. I'm showing someone who's 59, they got $400,000 and they're married. And their spouse is 60, okay? And the funds that are going in are non-qualified. I'll tell you though, the payouts don't matter. Whether it's non-qualified, whether it's 401k money, IRA money, it's all the same, okay? It's just really, if it's in a qualified account or a non-qualified, that just changes how it is taxed, okay? But the income is exactly the same. All right, so, and again, we're looking at a fixed index annuity, the top FIAs with an income rider, but I'm going to show you them without an income rider, without the fees as well. As you know, especially if you're just looking for growth, you don't need income, or you don't need guaranteed lifetime income, I'll show you those options as well. Okay, so, but just for this first quick example, this person funded this at $400,000 and then they waited to take income at age 65, okay? And their spouse is 66. They're going to take it out as joint income for the rest of their lives. All right, so based off of that, you can see the highest payouts per carrier, starting with Corebridge. Corebridge Financial, been around 100 years, $45,000 a year joint income for the rest of their lives, okay? That's not bad, not bad. And so the next one, Equitrust, great company. They're B++ by AM Best, but they're A-rated by Fitch and also Standard & Poor's. So definitely an up-and-coming and very, very strong carrier. You've got Nationwide, they're A+ rated, a little bit younger of a carrier. You got Nassau, over 100 years old. You got Aspida, they've been offering annuities for about 2 years. And then you got life insurance company of the Southwest, owned by National Life Group, been doing it longer than anyone on the planet. So lots of great options, but if you're just looking for highest income, then it makes it very easy because we know we can get $45,440 for the rest of our lives. And of course, you know, things could be different. You know, you might think, you know what, I don't want to wait till 65. I'm going to take my Social Security at 62. What's the income at 62? Okay, well, let's take a look. 62 and 63, okay, because remember, it's joint income, roughly $35,000 a year, okay? So you can see Equitrust is beating Corebridge, but not by much. What, $800 a year? So maybe $60, $70 a month. So not a huge difference if you're looking for an A-rated carrier. Now, let's go further and say, well, let's say you are single. You're a single guy, you got 400 grand, and you want to have as much income as you can, and you want to take it at 62. Well, not bad. All right, so we're at 41,000 with Equitrust versus 37,000 with F&G. If you want to stick with A-rated, F&G is the best choice. But Equitrust is still a strong company, so I have no reservation recommending them. That's $41,000. So that's great, $41,000 for the rest of your life. Okay, you take that out for 30 years, it's a lot of money, $1.2 million, not bad. You live longer, you're gonna take out more, okay? But let's take a look at this a little bit further. I'm gonna change this back to joint. I'll keep the age at 62 because maybe you're 59 and you do wanna retire earlier, which a lot of my clients do. And again, if you wanna talk about annuities, book a call. There's a link below this video and we'll chat about your situation. I'll show you everything, no fluff. I'm not going to try to sell you anything, but I would love to help you. If you are looking to purchase an annuity, I'd love to help you do that. Okay, so let's take a look at age 62 joint, $400,000. We've got, let's see, $34,914. And if I wanted to, well, let's say I don't want to have a rider fee, okay? No rider fee. The income's now $25,000. So quite a bit less. Okay, followed by what? Midland National, American Equity, Meritas. So again, if you're looking for highest income, I would recommend the rider. Yes, you're charged for it, but the only reason why you do not get a fixed index annuity without an income rider is because if you don't need income, you may just want growth. But again, this is showing you if you want income, guaranteed income, plus you want your account balance to last longer for a death benefit, it's a great hybrid. You kind of get the best of both worlds. You get to leave more money behind to your kids or whoever your beneficiary is. And if you're okay with less income for life, then you still get guaranteed income. So it's a good happy medium. So I would definitely, no reservations, recommending both of these choices. I work with both these companies a lot. But most people are like, no, I want the income. And so they'll pay the rider fee, which in my opinion is worth it. That's what me and my wife are going to do. And you can see the income is like $10,000 more a year. So I'll look at this and say, all right, well, what's the real cost? what's the opportunity cost? Okay, I mean, I'm paying a fee, right? Yeah. So let's look at the fees. See the fees here? Here's a rider charge. Starts at $5,000. You can see that going down over time because the account balance is going down. You're taking income. But by the time the account balance is gone, well, the rider charge, they can't deduct anything else anymore, right? So it's all gone. So yeah, so what am I really paying? Well, during those 13 years, not a lot, in my opinion. I mean, and that's with no growth in the index. So let's look at decent growth in the index, okay? Well, decent growth in the index, my account balance is going to last a lot longer. It's going to last till I'm like 80. That's not bad. The income's still the same. The income's guaranteed regardless. So just remember, it's a guaranteed feature of a fixed index annuity with an income rider, okay? And some of these that don't have the income rider charge, it's still a guaranteed portion of it, but it's just not as much because you're not paying the fee. All right, so let's look at the fees. I'm starting again with around $5,200 because I had some growth, and then slowly goes down to 0 by the time I'm 80. So, if I'm paying that rider charge for 20 years, you can see it goes down over time. Let's say an average of, I don't know, it's kind of high in the beginning and lower in the, let's say an average of, I don't know, $2,200 a month. Let's just be safe here. So 2,200 times 20 years, $2,200 a year, excuse me, times 20 years, it's $44,000 in total fees. Okay. So $44,000 in fees, well, that's pretty hefty, right? Well, yeah, I guess, but if I'm taking income out for 40 years, okay, I'm 62, I'm married, and statistics show that I'm going to probably live into my 90s because I am married and I am in my 60s. Those are real statistics. So based off of that, that's 40 years of 34,914. It's 1.396. So roughly $1.4 million of income. That's pretty good. Those same 40 years, okay, if I decide not to pay the income rider, I get $10,000 less per year. It's $400,000 less in income, lifetime income. So you be the judge. Is it worth it to you to pay another $50,000 in fees to get another $400,000 in income? Yeah, I would say. I mean, for me, it would be. I mean, I pay $100,000 in fees if that's what it took to get another $400,000. Because for me, it's all about income. But for you, it may not be. And if it's not, great. You can still take $25,000 out every single year for the rest of your life, and your account balance will last longer. You'll take out $1 million instead of $1.4 million. You won't have those $50,000 in fees, so your account balance lasts longer. So that's nice too. So it just depends on what you're looking for. Now, we've talked a lot about income. We talked about securing higher incomes with an income rider attached to your fixed index annuity. We've also looked at ones that have no rider fee. Let's look at ones just for growth, okay? You might be thinking, you know what? I don't need income at all, okay? I've got my pension. Okay, I've got my Social Security. I'm good. I just want some growth and I want some market protection. It's great. So we can look at that. There's so many different companies out there that you could choose from. See an IRA, same money. It shows you all the different companies that you can choose. But let's kind of narrow this down a little bit further. Let's look at performances, okay? We all want to actually know what they've been doing. Now, if you notice up here, it says hypothetical historical performance. Okay, hypothetical. I know you would know what that means, but let's talk about that a little bit more. These insurance companies, they will create these indexes, sometimes brand new indexes, and then they will back test them for 10, 15, 20 years and say, hey, look, as long as the participation rate stays at, well, you can see here, 550%, you're going to get these returns. You're going to get 53% every single year for 15 years. What they don't tell you is that those participation rates change every single year. Well, they do tell it in the fine print, but your insurance agent usually doesn't talk about it very much, okay? Well, if you want to talk to someone who's transparent, that's me. Book a call. We'll talk about all the top annuities. So what I look at and I say, all right, well, I've got the Credit Suisse. Well, Credit Suisse, we know that's been around for a while. But you know what? 3-year crediting? No. I just talked to a guy on the phone today, and he made zero because he had a 3-year strategy, you know? That's the problem. You could have a lot of growth in 2 years and lose it all in the 3rd year, and you've got nothing. Okay, I'd rather do something that grows at least, gives me interest credits every year so you have more compounding periods. That to me is a better deal. So I'm going to go in here and say, you know what? I want a reset period of annual. Okay, so good. Now you notice that it's a little bit more reasonable. Now I'm looking at 20 years of 5% on these. I'm like, well, I don't know. But I obviously have a high 10-year, but this, of course, is based off of a participation rate of 170%, which may stay the same, but most likely it won't. So I'm going to go in here and say, okay, well, let's go in here. I want to look at the S&P, okay? Because the S&P it's been around for a long time. We know what it's done. We know what it'll likely do, okay? So based off of that, now I've got something. Now I've got last 10 years, 10%. Last 20 years, 8.68, okay? It has longevity. But if I'm looking for highest growth, I'm like, well, you know what? Security benefit, A-rated company. They're giving me a participation rate of 90%. So if that market does, if that account does 10, I'm gonna get 9. That's pretty good. But there's an account fee of almost 1%. Okay, well, you know what? Maybe I don't want any fees on that. So let's take a look at that. No fees. Okay. Now we can see one. Yeah, 7.75 for 20 years. That's still not bad. The S&P, keep in mind, is averaged 8% over the last 100 years. That's pretty good. So, you know what? Let's just take a look at that one right now. Let's see what we can. Oh, we got the performance there. That's fine. Let's see. I want to actually see an illustration here. There we go. Okay. So hypothetically, if the index shuts down, S&P shuts down, probably got bigger problems, but if it does, then we've got 400,000 that stays there. But then, hey, this is kind of nice. After 10 years, they'll automatically bump your contract value to 440. It's nice. So that's basically kind of a little extra benefit if you leave it in there and it does nothing. So it's always nice to know that if nothing happens with the indexes, the insurance company still has to give you something as a minimum. At least some of these will. Okay, and this one, it does. Or hypothetical, we can look at, well, here's what it could look like. As long as, I'll go back up here, as long as the participation rate in this stays at 61%, they never change it, then at the end of 10 years, that contract value is worth $761,927. Wow, not bad. Not bad at all. So that's probably what I would push you towards when we meet. If you're looking for an index annuity and you don't want income, maybe you don't care about the income rider. Most people want it. Most people want the income. But if you don't want that and you're just looking for market protection and you want as much growth as possible, then I'm going to be showing you things like this. I'm going to show you top options like this so that you can get the most growth, the most compounding periods with a great company and with an index that's been around for a long time. Okay. It's stood the test of time. I'm not going to probably be pushing you into something that is an AI index. Okay. A lot of those indexes have been around for a year or two, and then they back test them and say, oh, this is what it would have done. Yeah, that's only if participation rates and cap rates stay exactly how they are right now. And they won't. They'll change. So hope this video has helped. If you like it, make sure you click the like button and subscribe and share it. And if you have questions, comments, put them below and I'll answer them. Of course, if you want to book a call, there's a link below this and it'll go straight to my calendar. We'll talk about all of your annuity questions, your needs. If you're looking for guaranteed income, if you're just looking for growth and market protection, I'll show you everything. Okay. It does not matter what I'm getting paid. Okay. I am going to show you everything. If it pays me a low commission, I'll show you the one that pays me a low commission if it gives you the most. Okay. And vice versa. Really, for me, I want you to be able to see everything that is available and not have to have some biased advice coming from an advisor who just wants to make a quick commission and will never talk to you again. Okay. So I'm not that guy. I would love to help you now, before and during the sale, and of course, after the sale. And of course, if an annuity is not right for you, that's fine too. Okay. Happy to help. So again, thanks again for watching, and we'll see you in the next video.